Thank you very much, Maina. Well, this is the session which I always call the Mwakenya session. So we're going to be having an outlook for the global and local session. So if you have not listened to anything, you need to listen to this session because you're going to get tips on how you should be putting your money 2026, so that when we come back for next year's forum, you have all the things you need. So first of all, Mati, during our first panel, we talked about the mindset being one of the things that really is a barrier when it comes to the ownership economy. So now I'd like to go to Kamunya. Tell us some of the behavioral shifts that people and African households need to do so that they can really participate in the ownership economy.
Thank you for that question, and thank you, everyone. Thank you, Abojani, for giving me this opportunity. That's a loaded question. The cultural shifts, the behavioral shifts. And one of the speakers here earlier said that human beings are inherently lazy. So what that means is that we have tendencies and we have ways of doing things. We have things that the way we are used to do things, it's just been done like that. And that's how we grew up. That's how we have been cultured. We have been cultured in our traditions, in the way we were raised, in our religion. We kind of have been brainwashed, so to speak. And so there's so much work to do because when we talk about money, money is not an emotional thing, but we use and spend money very emotionally. Money is an object. Money is a material resource. And so for us to be able to interact with money, then we have to shift the way we think about money. We have to shift about the way we think about money, the way we were trained, the way we were taught or not taught, and we have to get rid of all those tendencies. I tend to call them heuristics. Heuristics are mental shortcuts. Shortcuts that you say, for example, you have had panelists here say, buy real estate. And so when somebody asks you, why are you buying a house? I don't know. My mom bought a house. My dad bought a house. Everybody buys a house. So I'm going to buy a house. And now there is the new thing. Everybody now knows how to invest in the stock market. So I'm just going to invest in mutual, what do you call them? Money market funds. Why are you doing that? I don't know. Everyone is doing it. And so what we need to do is to realize that we need to be objective with money. You cannot be emotional with money. Let the numbers lead you. That is the behavioral shifts that we need to do. We have had a lot of conversations here, being given tips, 1 to 10 points of do this, doesn't matter. What you need to do, look at yourself, look at your numbers, where are you at, what do you have, and then start from there. That is the shift that we need to do.
Thank you for that. And Robert, Kamunya has put it very nicely. Some people just do things because everybody is doing it. But what other mistakes are people making that is really preventing them from participating actively in the ownership economy?
Yeah, so I'll talk of two things that most African households are culprits of, and that is they don't plan for school fees or education. They say kila mtoto anakuja na sahani yake. So when you get the offer letter, you've done well, you've celebrated you on TV, Alliance, whatever, but no school fees. But you are not born at age 13. All that time from the first birthday, people are just wishing you to go to that school. But that was an emotional decision. So a financial decision or goal means that you align what you want with the financial resources. Yeah, so if your dreams are in dollars, please also plan in dollars. Last year, some parents had to bring their kids back from the UK because suddenly the GBP went to over 200 versus Kenya shillings. These are true stories. So we don't plan for that. The other things we fail to plan for, there are things like car insurance premiums. When they are due is when you get your insurance agent now texting you. And what happens, you might have to go to Fuliza and stuff like that. So just think that we need to plan any goals, dreams, and aspirations are things that you have. You should touch the financial obligation. Like my co-panelist Esther said, there are no emotions in money. It's logical. Yeah. So actually, if you look at it that way, then now your emotions will align. But if you are just emotionally driven, it means that you'll start taking loans from the first day the kids go to school. There are those classes where they just go to sleep, I think, at age 3. So imagine from that until they're 18, you'll never do anything because of school fees. Then that is how your mind now shifts to, now this is my investment. Once they get their job, I need to get my ROI. And that gives birth to black tax. So I think we need to do financial planning.
Yeah, indeed, children are not born at 13, so you must plan. Now, Mwathi, I'd like us to talk about some of the sectors in the Kenyan context, as well as Africa, that we need to be looking out for when it comes to 2026, and how can we position ourselves to make the most out of those sectors that are steady and are going to be growing?
Thank you for that question. Before I start, perhaps some context. So, I think over the last 36 to perhaps longer months, it was pretty tough to be in Africa in terms of investments. I think when interest rates, post-COVID, interest rates went up in the US, suddenly the dollar became expensive. Investments in emerging markets and frontier markets like ours in particular became less attractive. Why? To put it in a simple example, if you're an investor in New York earning 5-6% for your dollar in New York, why would you ship that dollar to Kenya to earn a similar return with political risk, with all sorts of risks that you find yourselves here? So that really starved economies of funding. And you saw it here. I think you saw it in the tech sector. You saw startups that was previously very well funded start to close. You saw it in our own finances as Kenya, as a sovereign. Suddenly people were asking, are we insolvent? Some of our neighbors went bankrupt. Zambia, for example, further afield, Ghana is another country that also, and Ethiopia actually sharing a border, also was essentially insolvent. So that was a very, very difficult situation. But fast forward to where we find ourselves now, the Fed funds rate, which is the main rate from the central bank in the US, which is called the Federal Reserve, but it's essentially the same as the CBK, does the same job, has been cutting interest rates. And this has allowed our own central bank to also cut interest rates, because you never want a big difference between the dollar rate, let's call it the central bank rate in the US, and the Kenyan one. It's not healthy. A wide one is okay because you can attract funding, but a small one is not so good. But anyway, so we find ourselves in an environment where conditions have eased, the storm has passed. So it's a lot more attractive to invest in this part of the world. And the last time I saw conditions like this was in the glory days of maybe, 2009-ish to maybe 2012, etc. Markets were booming. The Nairobi Securities Exchange was booming. Safaricom came to market. If you remember those days, Equity Bank, some smaller stocks like WPP, Scan Group, if you remember. I mean, there was a lot of stuff. Maybe it's deja vu, you can see it. KPC is coming next year. So I think we find ourselves in a really interesting situation where global conditions are more conducive to investments in Africa. There's a lot more strategic thinking by foreign countries. There's a lot less, foreign aid, because governments have realized they need to spend money on defense. And what's the simplest thing to cut? The money you're sending abroad. No one wants to cut social benefits. No one wants to cut school meals. You saw what happened here when they start cutting social benefits or increasing the cost of being a citizen. People rebel. So in the West, what do? They cut foreign aid. So I think we have to just get used to that, which means that we need to find the capital domestically to do some of these things, which is starting to happen. So when you look at sectors, you can think of it as an individual. So me as Muadi, what am I going to invest in? So you think, okay, so financial industry looks interesting. It's come through a very tough period. NPLs so non-performing loans are high. We know pending bills hopefully should be paid once the securitization, this is a big word, But it basically just means borrowing against future income. It's like, so someone's taken a loan against your fuel levy, and that should pay suppliers that are owed money. And hopefully that also starts to free up. So when you think about that, should start working through the financial system. So you think to yourself, okay, so I'll invest in banks because they look like a beneficiary of this. I think also as an individual, you look at, we've talked about equity funds. Certainly that is something that I would not underestimate at all. It's perhaps the most misunderstood product, but it's where the returns are. Everyone runs around looking at money market funds. Money market funds basically follow where the 91, 182 T-bill rate is, sub 10. Our equity fund this year has done plus 40. Last year it did plus 30. But yet it's the one product that no one really understands, but it's actually where the returns are. I mean, most of you will look at a stock like KPLC. At one point it was trading at almost 2 shillings less even. Now it's at 14, 15 shillings. Someone's made money there. But it was so obvious. If someone asked me, why is KPLC increased in value? I would just say, look at your electricity bill. I used to buy a unit at 14 shillings a unit, just number of tokens by the amount you pay. And then that went up to almost like 30. So I could tell you that KPLC's earnings were going to double. All of us did that mathematics and all of us got miserable, but you could have benefited by investing in the stock. So I think there's a lot of opportunity right now. Some of it you cannot do on your own. You cannot invest in infrastructure, which means that you have to do it institutionally. You have to find either a pension scheme, if you're contributing separately, that is forward-thinking and is thinking about opportunities in that. You have to think about funds. We're seeing a lot more diversity. So I think in the next year or so, you'll see a lot of things coming to the NSE, which allows you to perhaps invest in infrastructure, which is important. None of us can invest in a power plant separately. So I think that's some of the things. Obviously, financial sector, hopefully you start to see the consumer's wallet grow as there's more money in the economy. So I would look at consumer. I think there's a lot of opportunity, but we also have to get used to the fact that it's going to have to be driven domestically, not by foreigners, which is a good thing. I think a domestically driven investment story is a lot stronger. It's a lot less, it's not volatile. We understand Kenya. If something happens tomorrow, you and I get it. But someone sitting in Dubai or Kuala Lumpur doesn't understand. The other reality is that every dollar that used to come to Kenya has a lot more competition. We all talk about, I'll give you just an example as I end. We all talk about M-Pesa, the super app, being amazing. There's a company in Kazakhstan called Kaspi, Kaspi. Kaspi was a bank that basically became a fully digital bank. Kaspi, if you go to Kazakhstan, everything is on digital. You buy airplane tickets, you buy movie tickets, you pay for things at the restaurant, you pay for taxis. And that company, and you think Kazakhstan is a desert, essentially, with a much smaller population than us, has a market capitalization, listed in New York, double that of Safaricom. And it's essentially just an app, a digital app. So my point is that as we sometimes think about innovation in our world, that foreign dollar has got a lot more competition for it, which means that the resources have to come domestically from you and I. And the more we move our investments into financial instruments, which is what's happening. I think money market funds is just the first step, because after that, you'll come and ask us about our equity fund, hopefully. Our stand is outside, so very happy to talk to you about it all day long. And after that, maybe you'll get a special fund, you'll get to other things, but that is basically giving you financial freedom, because you can move in and out of products almost instantly, and it's liquid. So yeah, thank you.
Thank you, thank you. So there are opportunities for individuals, but there are some that need to be taken up through an institutional perspective. Now, Kamonya, you said you need to follow the money and don't be led by your emotions. So I'd like you to give us some practical tips where African households can actually integrate financial stewardship in their day-to-day decisions.
That's an excellent question. And so what we need to think about, it's true, money is not, money, well, there's something I tell people, respect money and money will respect you. Money is a thing. It's something we put value on. So when you buy, let's say, a dress, or you spend, or you do whatever you are looking at, and you say, I like this thing, I'm gonna buy it, and you follow your emotions, and you think that that thing is the value that it has been attributed to that thing. But the truth of the matter is, that is the value that you're giving that thing. So what I usually say is, always make a decision that is on an objective decision. Why am I buying this? For example, I tell people, let's say somebody is making 100,000 a month and somebody else is making 200,000. But as a lady, when you go to the salon and the salon is charging $1,000 for your nails or whatever, it doesn't matter what income you're making, you're gonna pay that money. So you have to ask yourself, what is this expenditure relative to the money in? Money in, money out. So you cannot spend like everybody else. You cannot, do like the Joes do or the Jones do. You have to look at your own situation. Always get into the habit of following your money and knowing what is your income. And I'm talking about the net income. After all the things that you have been deducted and everything, your income comes to you. And then you have to spend that income based on your needs and your wants, and you have to prioritize those things. I remember one of the panelists here said, pay yourself first. And we were told that, let's say you get your income and you decide, okay, I'm going to do 10% for my tithe, then do another 10% and pay for yourself, pay your future, pay into your future dreams. Because today you are working, but tomorrow you may not be working. Another panelist talked about emergency savings. Before you do so many other things, before you spend lavishly, just do those things that are the basic things, that are not emotional, that are things that make sense, and then you can reward yourself. You can buy that chocolate, you can buy whatever, but just learn, and it's good, and I know Abojani and other financial planners, we have like a spreadsheet, and you can just put your money in a spreadsheet and prioritize your things, your bills, your expenditure, everything, and then a lot of people, and we are here talking about investments and money market funds and saving into your retirement, a lot of people spend, and then they say, okay, what am I going to save? That's not a good idea. Make saving a priority. Make it like when you pay your bills, electricity bill, whatever bill, and your savings are just right there. Before you buy that new shoe, before you buy that new bag, those are the things you need to prioritize. And I will say one thing, especially in family conversations, it is a good idea to start teaching our kids how to relate with money, how to form a good relationship with money. Growing up, I don't know about you, but I grew up some time back, and I don't think we had a very good relationship with money. I think some of us grew up thinking that money is for the rich and we are the poor, and we just get by. But if you plan money, it doesn't matter whether you are making 10,000 or 100,000 or a million. When you learn to plan with the little that you have, then the more you have, the better you can plan. But some people think, I will wait until I have tons of money. It's not going to happen. If you don't respect money, money will not come to you. But if you respect money, the little that you have, and plan it well and teach our children how to plan it well, how to respect it, then money will reward you by coming back to you. That sounds like, a voodoo thing, but it is real. Money begets money. Because the reason why, and this is true, it's a principle, the reason why money does not follow you or me is because when you get money, you spend it all. If all you do is spend, and you don't take that money and make that money earn another dollar, and another one, and another one, how is money going back to you? It's not going to come back to you. That's why we are learning. Let's buy those investments. Let's do this, because when you invest that $1 or 1 shilling, and it doubles. We just had examples of stocks that have doubled, tripled. If you bought that 1 share of KPLC, and now it's how many? 7 times more. Then you are ahead of the game, and now money is begetting money. But if you spend that one, there's a story about delayed gratification. The reason why people spend money is because they don't want to wait. I was talking to somebody, and I told them, why, and I know their businesses, maybe they do this. Why would you buy, let's say, a TV or a phone on high purchase? And do the math and see how much you're going to pay for that. Let's say a TV, somebody was saying, okay, a small TV, it's a young man in the village, a small TV, it's only 18,000, but if I get it on higher purchase, I'm going to pay it in a year, and I'm gonna end up paying like 35,000 or something like that. Now think about that. In a year, you could save that 18,000 and delay the idea of owning a TV for a year, and then buy that TV cash. So it's those little things. Do the math. Now we need to teach our kids how to do the math, how to understand how money works, how to understand that money rewards people who respect money. But if you spend all of it, you're not going to have any money to make money for you. The best way to make money is to have money making money for you, other than you going to work and earning the shilling, and you just have the money working for you while you're sleeping. That is the best way to make money.
Okay, thank you. So you need to respect money. You know, the way Robert was saying, some people dream in dollars. I think that is you. You talked about $1,000 manicure, and I'm like, I'd like that. Huh? So Robert, let's talk about SMEs, because we've been talking about the households. How can SMEs position themselves to really take advantage of the ownership economy?
Yeah, so I think, first of all, we have to be candid and say that for the last over 130 years, where we've had banks in Kenya, mostly they will only tell you how to do bookkeeping, accounting, not even financial management. Then the second thing is how to get a loan, and that's done. So the conversations on SMEs, they are very recent in terms of helping you to create wealth. And the same on the insurance side. A good number that are just setting up the insurance value proposition for SMEs. So because of that gap, the whole idea for SMEs has always been keep your book records clean, you know, don't have issues with KRA, count 1 year, 20 years down the line, you basically have nothing. So I think it is a high time for SMEs to start creating wealth. And I usually tell them that the best way is to look at your operating expenses. So let's assume your operating expenses in a month are 3 million. So it means that if you save 3 million, we say that you bought 1 month worth of staying power. It means if you have 36 million somewhere in fixed deposit or money market, you have a whole year staying power. So if things like Mandamano come up or COVID, at least you can survive. So the big corporates, what helps them to survive is because they have buffers, and that can buy them the bad days. So currently SMEs are too exposed. So they need to also start that saving culture. So there's an idea known as profit first approach. So that invoice that you are sending of 1 million, ensure that profit is included there. It could be 100K. When it comes, put it in profit account and invest it. So that way you'll be able to grow your buffers over time and invest so that the business has more avenues to innovate and try out new things. Because people with buffers, they tend to also take advantage of the new innovations that come up. Because innovation is a luxury. If you are about survival, it's very difficult for you to innovate. But people with excess, they can try out 2, 3 things, one of them will work. So I think SMEs need to do buffers and also look at insurance tools that can protect the downsides in case things go wrong. So things like fire insurance, whatever it is that is relevant to your business, have it so that can now transfer that risk to insurance company. Then finally, this idea of informal, it is a nice word, but I don't like it because people in informal believe that something big is going to happen to them to prosper. So because of that, they don't do much in terms of things like insurance and retirement. And we should know that we are exposed as a country with 83% of our economy being informal. And that has got very far-reaching implications in terms of how well will you retire and even your ability to move to the next level. So if you are formal, you can actually grow faster and you can attract the best talent. Many people would want to be associated with you. And that's something you can start from day one. If you're an SME, if there are opportunities to do things like medical insurance, life insurance for your staff, whatever you can do them, because those buffers tend to make people more loyal and more connected to your ideas. So just say, let's get into financial markets, from informal to financial markets, in terms of how we organize ourselves and using the tools that have made even the great corporates great companies. Thank you.
Thank you for that. And as we talk about building buffers, Mwathe, I'd like you to speak briefly about diversification and how we can grow cross-border portfolios and take advantage of opportunities.
So diversification, we all know the old saying, don't keep all your eggs in one basket. That's basically what diversification is. It's a term that may sound scary, but it's just saying spread your risk. Don't keep your chickens in one place, don't keep your eggs in one basket. So diversify your investments. It's sometimes harder to do than you think, but actually, this is where investment firms like us and some of the other people who have been in here help, because this is what we do. We offer you, if you think about the word of collectivized investment schemes, CISs or unit trusts, whatever you want to call them, that's essentially what they are. They're giving you an avenue for diversification. Now, you can diversify on yourself. That's fine. You can have some money in some stocks. You can have some money in a fixed income or a money market fund. You could open an account with one of these FX guys and do some FX. The question is, how much time are you able to spend on it? How much time are you able to dedicate to being on top of the information, just to make sure that your nest egg or your investment is safe? Because all these things need tending. And tending is being on top of things. So I think this is where and I would say you need to diversify in terms of products, and you need to diversify in terms of regions. So, if you ask me personally, when someone tells me that they've bought a Kenya Eurobond because they're looking for a dollar investment, that is not diversification. You're just eating the same risk in a different way. And in fact, actually, you're probably more exposed because the Eurobond market is more liquid, i.e. the price moves up and down a lot more than if you bought a infrastructure bond or something. So if someone is buying a Kenya Eurobond, the need was probably to diversify into dollars and reduce Kenya FX risk. So perhaps you should be looking at something that is not African, for example. So something that is completely delinked. I would be looking at something that is probably an oil exporter, not an oil importer like us. So if you think about the cycle, when oil prices are high, we suffer because we import oil and fuel. But so you want someone who benefits. So perhaps you look at someone like Nigeria, or you look at another big commodity exporter. It could be gold, it could be just something that's delinked to us. It could be Morocco. I'll give you an example. Morocco is a big exporter of automobile parts to Europe, and it's very linked to Europe. So if you want exposure that's not so Chinese, but is in Africa, Morocco is an interesting place to look at. So I think, but these are really complex things that I don't expect you to be sitting there working out how many car parts are being exported from Tangier to Marseille. So you need to find the right investment professional and find the right funds, the right products, and they'll give you that diversification. because the world is so interconnected. And the last thing you want is, for example, what happened here not so long ago. Interest rates went up, which means that bond portfolios were worth less. So bonds, the value of a bond moves in the opposite direction to the interest rate. So when interest rates are high, the value of that asset goes down. So when interest rates were at 18%, anyone who was sitting on a bond holding was really suffering. So like pension funds, etc. Property also behaves in the same way. So it meant that actually property values also went down. At the same time, we also had a bear run on the NSE. But if you are diversified, this is exactly the same time when the Magnificent Seven was happening in the US. You know, this is when you would want to have been invested in NVIDIA and Meta now, and all these kind of things. But you wouldn't want to have been invested in China. China was having a really horrific run, but India was super strong. So this is the element of diversification. So find an institution, find a product, think about what they're doing, interrogate them, ask them the hard questions. If they can't answer the hard questions, that's not the right place for your money, I would say to you, because they should be able to do so. And then just keep it somewhere safe.
Okay, so we need to have them answer the right questions and the hard questions. Now, Kamunya, as we start to wrap up this session, I'd like you to tell us how long-term money management can lead to sustainability. Paint for us that picture very briefly.
I think that's actually where the rubber meets the road. A lot of us want to make money and make it quickly. But true wealth is built through patience and through longevity, looking at the long term, because, as I said, money begets money. So let's say you put 100,000 shillings in one of the funds that Mr. Mwadhi is talking about, and you earned 10% on average a year. I'm just being very conservative. And when you look at that money, the next year is gonna be 110,000. And when you look at it the next year, if it's compounding, 110,000 will give birth to another 10%. And during that time, you're not seeing, most of the people say, oh, I'm putting this money here and I don't see any returns. But then things start to happen. When you leave that money there longer, and then it keeps growing and growing. And one day, if you do a calculation, if you go to your investment calculator right now and put 100,000 growing at 10%, if it's growing at 10%, it means that every 7 years, you're going to double that money. And then another 7 years, you're going to double that money. Before you know it, the money that you invested there as principal is now making more money than what you invested. That's a fact. It's a mathematical fact. It's a powerful principle of compounding. Now, here is another thing. Let's say you start, wherever you are, young, old, it doesn't matter. What if you dedicate every month or every paycheck, you add some more money in that fund? Now you're doing something that is called dollar cost averaging. Now, the investors will tell you that today KPLC is this amount, next year is another amount. It goes up and down and up and down. But every time you are putting money in there, sometimes you buy low, sometimes you buy high, and so you are dollar cost averaging, but you're also increasing your investments. And if you leave your investments there, one day you will not have to worry about money. And that is a fact. So dollar cost averaging is a good thing. Patience is another good thing. It's called duration. Today, the market could be down, it's bleeding, it's bleeding, it's bleeding, but the next minute, the next year, the next 5 years is gonna go up. The market is very strange. And Warren Buffett says that the market, the way you make money is when people who are cowards, people who don't want to leave their money in the market, they are scared, they want to sell. That's why you make money. You make money, the patience make money from the impatient people. When the market is going down and people are selling and selling and selling, that's when you invest. So, and somebody says, cash is king. So how are you gonna invest if you don't have some liquidity? That's why it is so important to have that cash to be able to look at things long term. Of course, there are some things you will do short term. Let's say you wanna buy a house in the next 1 year, 2 years, 5 years. That's short term to medium term. As we talked here again, we talked about education. And if you have a child, the best time to start investing for your child education is when? When they were born. When they are born, not when they are 13. When they are 15 is when you are starting to think about, oh, we need school fees. So those are some of those things even before you get married, especially when you are young. You know, I listen to people talk about risk tolerance and all that. And to tell you the truth, when you're young, if you can like really learn how to invest when you are young. If you are lucky, if you are young, you are lucky because you can start. And you just learn how investments work and how risk mitigation works. You will not be buying money market funds. You would not be buying, bonds. You would not be doing that when you're young. When you're young is when you go all in the market. Is when you want to take more risk. That's how I understand it. That when you're younger, if you are educated in investment, it's the best time to take risks. And remember, the more you build wealth, it will come a time when you can take up more risk. The reason why people are scared of taking risks is because you don't know what you're doing. And if there's anything we can get from this conversation is, a lot of people are scared of doing those things long term because we don't know what we are doing. We want to be experts. We cannot be experts. So it is good to get yourself a good financial advisor, a good investment advisor, and a good risk management advisor. I'm talking about insurance, I'm talking about those things. It's part of the long-term game. Insurance is part of the long-term game because that's how you protect your wealth, that's how you protect your income, that's how you protect you as the income earner. Because if you cannot wake up tomorrow and go to work, you need to have mitigated that risk so that if you can do that, then money is still coming in. So that's how you do the long-term game. You look at all those things with an advisor. We just had we listened here and we know about the global markets. How can we understand that? But we can work with a reputable organization, a reputable advisor. I love the idea of financial planning. I love the idea of having a financial planner because then they can help you demystify all this. Now we have many banks here. We have many investment holdings. How do you choose one from the other? So you need a good financial planner who will walk you through those things, who will check, like we had a legal person here, the credibility, the years in investments, the experience and all that to be able to choose all those things. It's complicated, but it's simple.
Okay, thank you. And Robert, as you wrap it up for us, I'd like you to tell us the sectors and the biggest opportunities actually for SMEs and retail investors to look out for in 2026.
Yeah, I think for SMEs in Kenya, the biggest opportunity is to start looking at what we call expansive markets. So an expansive market is a market where you don't need anyone's permission. So let's not be afraid of it, because going to the government and corporates, you need a lot of permission, and that is why people are very angry at the government and corporates. But you won't have time to be angry if you are serving households and MSMEs, because they tend to be prepaid and they are big markets. Like in Nairobi, there are over 5 million households, right? So it means that if you can get even 100 households that are paying you well on a monthly basis, you can still have a great business, grow it to 200, because wherever you go, we all go and then we come back complaining of pending bills, 90-day invoices have not been paid. So I think for me, that's the biggest opportunity. So we are using a stale monetization model in Kenya, where you are all responding to RFPs, tenders, 1,000 of you and only one person will get it. You wait for another tender next year. But these are the market is waiting for us. With more Kenyans becoming affluent, the opportunities for do-it-for-you services, legal services, whatever you have as a professional, productize it and monetize it. Because you all pay medical doctors for consultations. You also are professionals, so you need to start getting paid. So let's look at that as an asset class. Then for individuals, my high conviction ideas for next year, for offshore, I'm looking at Amazon. Then for local markets, our stock of the year for 2027 is Safaricom. Then we're also keenly looking at Diamond Trust Bank. Thank you.
Thank you so much. A round of applause for Robert, Kamuya, and Mwathi. You have your Mwakenya, so invest wisely for 2026. Thank you very much.